we've got, Do Kwon's proposal to revive Terra version 2 and Luna 2.0 have been approved by the Terra community. This even as the fallout from the collapse of Luna and algorithmic stablecoin USD continues to be felt throughout the crypto industry. Joining us now to discuss is Alex McDougall, President and CEO at Stablecorp. Hi, Alex. So,
Hi,
the
everybody.
wider stablecoin, good morning. The wider stablecoin market has been impacted by the Terra ecosystem. Terra USD was an algorithmic stablecoin backed by another cryptocurrency, Terra Luna. It was incredibly risky, which led to a death spiral, and now basically near zero value. But not all stablecoins are created equal. What do you think is the lasting impact on the rest of the stablecoin market of this death spiral?
Absolutely. No, it's a really, really visceral and unfortunately painful reminder of the fact that a lot of cryptocurrency and a lot of digital asset market is still in skunkworks mode. So a lot of this is experiments in completely novel forms of economics, completely novel forms of creating value transfer, and it's happening in public and in real time. And that's the joy of the open source digital asset market, but it also leads to some extremely painful realities, such as the Terra and Luna meltdown. So from a broad perspective, I think it really shines a light on what's kind of production ready and what's still in that skunkworks and experimental phase. And what's really interesting about digital asset is we sort of tend to pour assets and resources into the experimental phase and minimize a little bit what's more on the production side. So I think what this has really done is kind of shine a light on this evolution between the two of what is a stable-ish coin and what's really based on math that happens to give you a value of $1 at the end, versus where we're really sort of importing some stability from the traditional finance world with an actual fiat-backed or an actual asset-backed type of stablecoin. So I think what we're going to see here is sort of a bifurcation between the two of these more experimental types of coins, which as an industry, we really need to continue to stay behind. We need to continue to innovate. That's really the whole point of what we're building. But I think we're really going to see sort of a return to safety or a return closer to where we started stablecoins, which was porting in stability from the traditional financial sector, which has its own stability issues right now as well.
It's interesting that you say that, Alex, because so many people lost so much money, especially retail investors, from Terra Luna, and I don't know, how do we protect consumers from that kind of fallout who may not have known about a death spiral or the dangers of a stablecoin like USD being so experimental? And then I have a follow-up on that.
Yeah, absolutely, and it's a fantastic question that I'm sure we will address in the aftermath of this. Now, the products that we're working with at Stablecorp, the VCAD digital deposit receipt, is actually a representation of a deposit within a federally regulated Schedule I bank. And so, disclosures around things like that, and disclosures around investor protection, and disclosures around what is being created within these experiments and who gets to play in those experiments. Is the absolute critical next discussion to have. Experiments are great, but this is a significant investor protection issue as well.
What do you think, Alex, of already we're seeing Terra version 2, Luna Classic, like this quickly, the turnaround?
It's classic crypto markets, right? You have an event, things happen, machine speeds, everything happens at machine speeds, and so it's on to how do we revamp, how do we learn, how do we go from here? Now it's up to investors, and it's up to users, and it's up to the broader market whether we give that type of experiment a second chance. There's been very public, and again, joys of transparency of blockchain. You can see exactly transaction by transaction how this meltdown occurred. So we get to decide whether this is a structure that has sufficiently mitigated the risks, or does the next iteration get to rebuild that structure? And again, I think it's really going to be kind of a return to quality or a flight to safety here.
Yeah. Well, buyer beware. You mentioned flight to safety, flight to quality. So Tether, the world's largest stablecoin by market cap, has decreased by 10 billion in market cap, while USDC, the second largest stablecoin, has gained about 5 billion in market cap. So I wonder, why are we seeing this flight from Tether to USDC, and will we see a flippening?
So, great question on the flippening. I think that USDT really got out of the gate strong. It solved an immediate need in the early stages of crypto, and it governed and it allowed people to do things that they weren't able to do previously in sort of the pre-era of stablecoins. And USDC really has come along and become kind of the grown-up version of USDT. So more transparency, more asset reporting, a more regulatory focus, easier redemption. And so I think you are seeing exactly that flight back. So from the where people for a long time almost didn't believe that there was a possibility for the peg to break because we've had examples of it of things working for quite a period of time. I think this was a really big wake up call for a lot of people who said it doesn't matter what Tether has behind it, it's always going to be $1. And then you see a very public view of it not being $1 anymore, and you start to see that kind of flight to quality. So I think this is really an example of USDC and the way they've constructed their assets and the way they've constructed their asset base and their reputational base really kind of shining through.
Alex, when we step back and well, first of all, let's do this. We've known for months that there was a problem with the model for UST. I mean, this is something that nobody had especially since the collapse of iron finance. Everybody kind of knew that algorithmic stablecoin structured the way UST was, it just were inevitably going to fail, and that this anchor 20% APR that they were paying was basically a version of a Ponzi scheme, even if they didn't think that was. Nonetheless, they tried to keep everything based on the US dollar. And there's an argument that's being made now that when we look at what grew the demand for UST and what grew the demand for USDT, it's ultimately the lack of KYC, that people wanted a way to use dollars and have that dollar exposure in a sketchy manner for unsavory purchases, not just for crypto, but for other things, that it was a way to do it. How do you counter that criticism that ultimately some of the biggest demand for stablecoins come from people who basically are trying to get around the law?
So, I agree with you in that there's always going to be bad actors that are looking at systems and structures and cracks in it and looking to exploit those. I think the majority of stablecoins, especially for this next evolution that we're looking at, which is really around fiat evolution type use cases, on-chain FX, remittances, payments, cross-border payments, it's almost the complete opposite. And I think this is part of what you're seeing with the USDT to USDC route, is we're looking for those well-constructed stablecoins that have transparency and what we're building with VCAD, with the bank-issued model, that need to operate within KYC systems, that need to operate within places where a merchant's not going to be worried that their dollar is going to be worth $1 the next day, and that need to operate within kind of the purviews of our existing KYC AML structures. And with well-constructed stablecoins, the transparency that's inherent in blockchains is actually quite a bit more significant than what we have in some of the traditional fiat type of AML structures. So if we can build it correctly, I think we can actually create a way better structure for how we can trace bad actors, how we can have visibility into shady transactions and those types of things, and really create and unlock this next evolution of stablecoins, which is really into those more traditional type fiat replacement roles, which we haven't done a great job so far because of all of these worries, all of these issues, all of these regulatory questions around the existing and traditional stablecoins. So I think it's a bit of an evolution of the model that gets past that.
You brought up VCAD, and when we look at the total assets that are, when we look at the size of the stablecoin market, it's almost entirely U.S. dollar denominated. I mean, we've had attempts at a kind of a stable euro and a stablecoin based on the euro, stablecoin based on Chinese yuan, which has other issues, and one on the British pound, etc. What is the demand for specifically a loonie, a digital loonie, if you will? What is the demand for Canadian? This is first of all, Canadian dollars are very commodities based. It's almost the U.S. dollar stripped out for its commodities portion because of its trade in commodities with the United States, particularly. What is the demand overall in the crypto markets? And especially getting back to the previous question, drug dealers and things and the like still like the U.S. dollar. I mean, they're not necessarily buying, taking in Canadian dollars to go spend it in the six. I mean, what's happening here? I mean, like, where's the demand?
And luckily, we're hoping that drug dealers do not use our asset specifically for that reason. No, it's a great point, especially in the Canadian crypto trading landscape. So two pieces to your answer. One is a ton of it backs onto US dollar liquidity. But whenever you back into the traditional fiat FX markets, you're breaking the on-chain model. You're forcing in those T+1 settlements, those international wires. You're forcing in those cross-border frictions that the entire point of digital commerce is trying to solve. So the way we've constructed VCAD is we have really close partnerships with several American US dollar providers. So Circle being one, and creating those institutions and structures whereby the Canadian dollar digital asset trading market that already backs onto US dollar liquidity, now we can do that whole backing onto US dollar liquidity significantly more efficiently. And the way we've kind of built our structure and our cap table as well is really around institutional partnerships. So eventually, we'd like to be able to break that U.S. dollar liquidity and really have our own Canadian settlement rails. And so when we're looking at cross-institutional settlement within Canada, currently it's very isolated because it all backs onto the U.S. market. So as we can create these really simple webs of commerce within the country, we think there's a really, really, really interesting opportunity to be able to create this native Canadian dollar version of digital asset commerce.
Just one final question, which none of our guests or most of our guests have not been really able to answer, which is how do you regulate algorithmic stablecoins? Because this is probably the next thing that's on the horizon, but nobody seems to have a clear idea about what that would actually look like.
Yeah, and it's really interesting, and I say this in the in the most constructive way possible, is that we can learn a lot from our existing fiat structures. There is a central bank that basically has an algorithm that manages stability within tolerances. There's a certain level of opacity that's required so it can't be ultimately gamed, which is a challenge with existing algorithmic stablecoins when everything's laid out in black and white, and that's by design. So, I mean, really creating a on-chain representation of what we've figured out as the off-chain structure that governs algorithmic or fiat-based coins or fiat-based currencies today is a great place to start. But regulating them from a securities law perspective, regulating them from a consumer protection perspective, I mean, I think you need to start with disclosures. There needs to be an extreme amount of transparency into what's underpinning these, how it works, what are the case studies, what are the risks that are inherent in it, and really working on whether there's an expectation of profit as well. So if this is expected to rise in value, if this is expected to be able to be used for speculative purposes and pieces like that, and starting with kind of the core bits of what do we regulate other assets towards, sort of taking it back to a very first principles approach. So I think there's really interesting precedent in what we've built in sort of traditional commerce, and there's really interesting precedent in how we've looked at some of the other types of digital assets that we've had a little bit more success in regulating. So there are precedents for it, but it's challenging.